Let me tell you something that most people will never understand about money. Not because it is complicated, it is not, but because understanding it requires you to accept something deeply uncomfortable about the world you live in, and most people would rather stay comfortable than stay solvent. Here's the truth. Right now, at this very moment, while you are sitting there reading your bank statements and feeling proud of yourself for saving your money, is dying. Not crashing, not collapsing in some dramatic headline event. Dying quietly, slowly, the way a slow leak kills a tire not on a blowout, but in a gradual, nearly invisible loss of pressure until one morning you cannot move. That is what inflation does to cash. And here is the part that will keep you up at night if you truly understand it. The bank is not stealing from you. The government is not robbing you with a gun. There is no villain to point at, no enemy to blame. The thief is invisible. The thief is mathematics. And mathematics does not care about your feelings. It does not care that you worked hard. It does not care that you were disciplined enough to save when your neighbors spent everything. Mathematics is indifferent, and indifferent forces are the most dangerous forces in the universe because you cannot negotiate with them. I have been watching this game for over 70 years now. I have watched empires of wealth get quietly dissolved by men who thought that holding paper was the same as holding value. I have watched brilliant men with PhDs, men with Bloomberg terminals and private jets make the exact same mistake that a farmer's widow in 1922 Weimar Germany made. She held her life savings in cash. She watched it become enough to wallpaper her bathroom. Literally. People papered their walls with it because the currency had become worthless. And she was not ignorant. She was not reckless. She simply did not understand the fundamental nature of what she was holding. And here's what I want to tell you today. Here is why I'm speaking to you right now. That mistake is not ancient history. That mistake is not just for people in failing economies or banana republics. That mistake is being made right now by millions of ordinary, hardworking, well-intentioned people who believe that because their number on the screen is going up, their wealth is growing. It is not. The number goes up, the purchasing power goes down, and the gap between those two realities. That gap is the silent tax that nobody voted for and nobody can stop. So today, we are not going to talk about hot stock tips. We are not going to talk about cryptocurrency or some clever arbitrage scheme. We are going to talk about something far more important. We are going to talk about what actually holds value when paper does not. We are going to talk about how to think, really think about money in an inflationary world. And we are going to talk about what I have done, what I have seen, and what every serious long-term investor understands that the crowd never will. Pay close attention. This will be one of the most important conversations about money you have ever had. Let us begin. STT. Now, before I give you the framework, let me tell you something about how I am going to structure this. I am going to walk you through what I call the 5 anchors. Not tips, not tricks, not a hot list of inflation-proof assets to buy before Monday morning. Anchors. Because when inflation is hot and the financial world starts to feel like a ship in a storm, the person who survives is not the one who runs the fastest. It is the one who is tied to something real, something that the storm cannot dissolve, something with weight and substance and genuine economic staying power. There are 5 of them, and together they form a complete philosophy, not just a portfolio strategy. Now here is my difficulty warning, and I am serious about this. Every one of these anchors is simple to understand. I could explain any one of them to a 12-year-old in 15 minutes, but understanding them and executing them are 2 entirely different things. Because execution requires you to go against your instincts, against your social programming, against the voice in your head that says what everyone else is doing must be safe. That voice has bankrupted more people than any bear market in history. So listen carefully. And then this is the critical part. Actually do something. Here is anchor number 1. The first anchor. The purchasing power lens. I want you to stop thinking about money in terms of numbers. I know that sounds strange. Numbers are how money is measured, right? The number in your account, the number on your paycheck, the number the Federal Reserve announces after its meetings. But here's the brutal truth. The number is a lie. Not a malicious lie, just an incomplete truth. A shadow of reality projected onto a wall. And most people spend their entire financial lives staring at the shadow, thinking they're looking at the real thing. Let me give you a vivid illustration. Imagine I gave you a box in 1970, and I said this box contains $100,000. That's your retirement. That's what you worked for. Don't touch it. Just hold it. Be responsible. Be safe. So you hold it. 50 years pass. You open the box in 2023. The number inside is still $100,000. Same digits, same ink, same paper. But here is what happened to the real thing inside that box. In 1970, $100,000 could buy you a beautiful house in most American cities, put 3 kids through college, and still leave money on the table. Today that same $100,000 might cover a used car and a year of one child's tuition. Maybe. The number did not change. But the reality it represented, the actual claim on real goods and real human effort and real productive assets, that got cut to pieces, quietly, across 5 decades of slow, grinding mathematical erosion. Now I want you to understand something about that process. The Federal Reserve targets roughly 2% inflation annually. That sounds harmless, right? 2%. A rounding error. But let me give you the mathematics. At 2% annual inflation, your purchasing power gets cut in half in 35 years. At 4%, which is roughly where we have been in recent years, your purchasing power gets cut in half in 18 years. At 7%, which we saw in the early 2020s, your purchasing power gets cut in half in just over 10 years. 10 years. Think about that. A decade from now, if inflation stays elevated, a dollar sitting under your mattress today will buy you 50 cents worth of goods. This is not a political opinion. This is the rule of 72. Divide 72 by your inflation rate, and that tells you how many years it takes for inflation to have the purchasing power of your cash. You must stop measuring your financial health in nominal terms and raw numbers and start measuring it in real terms, in purchasing power, and what your money can actually claim in the real physical world. I call this the purchasing power lens, and once you put it on, you cannot take it off, because you start to see that what most people call saving money is actually, in a hot inflationary environment, a slow form of voluntary impoverishment. Here is the comparative scenario. 2 men, both 40 years old, both saved $50,000 this year. Both call themselves responsible savers. The first man, let us call him Robert, puts his $50,000 in a high-yield savings account earning 2% annually. He feels safe. He sleeps soundly. He tells his wife they are being prudent. The second man, Thomas, puts his $50,000 into a diversified portfolio of businesses that produce real goods and services, businesses that have the pricing power to raise their prices as inflation rises. He accepts short-term volatility. He does not check his balance every morning. He understands what he actually owns. 20 years pass. Inflation averages 4% per year over that period. Robert's account nominally shows roughly $74,000. He feels okay about that, but in real purchasing power terms measured against what that money can actually buy, he has roughly $33,000 in today's dollars. He thought he was preserving wealth. He was slowly consuming it. Thomas, his portfolio of businesses with real assets, real pricing power, real human ingenuity behind them has grown at roughly 8 to 10% annually in real terms. Same starting point, completely different destination. Not because Thomas was smarter, not because Thomas was martyr, not because Thomas had better luck, but because Thomas understood what he was actually holding. Here is your assignment for this first anchor. Tonight, not tomorrow. Tonight, I want you to take every dollar you currently hold in cash beyond your immediate emergency needs, and I want you to calculate its real value. Go to any inflation calculator online. Put in the amount. Put in 4% annual inflation. Look at what that number becomes in 10 years. In 20 years. Do not abstract it. Make it real. Ask yourself, how many months of groceries is this today? How many months will it buy in 20 years if it just sits there? Feel the discomfort of that number, because that discomfort is productive. That discomfort is the beginning of wisdom. The second anchor, the productive asset fortress. Now here is where I will tell you what I actually do, what I have always done, and what I have been telling people for decades while most of them nodded politely and went home and did nothing about it. I do not want to own cash in an inflationary environment. I want to own businesses, not because I am a cowboy, not because I have some wild appetite for risk. Quite the opposite. I want to own businesses because a business is alive. A business is a human organism. It wakes up every morning and it figures out how to survive. It raises its prices when its costs go up. It finds efficiencies. It adapts. It grows. It breathes. Cash does not breathe. Cash sits there and dies. Let me give you the extended metaphor I always return to when I think about this. Think of your wealth as an army, not a metaphorical army, a real one. Every dollar you own is a soldier, and you are the general. Now, a general has two fundamental choices about where to deploy soldiers. He can keep them in the barracks, safe, comfortable, not exposed to any danger. They sit there, clean and organized, doing absolutely nothing. And while they sit there, something terrible happens that no one talks about. The enemy inflation walks through the barracks at night and kills one soldier per year out of every 25. Not dramatically, quietly, just a slow nightly reduction in your army's size. Or the general can deploy his soldiers, send them out into productive territory, have them working, building, creating, generating return. Yes, some days they lose ground. Some days the battle goes badly. But they are fighting, they are creating value, they are alive. And over time, over years and decades, a deployed army builds more than it loses. The greatest mistake I see people make with their financial lives is they confuse the absence of risk with safety. They see the stable number on their bank statement and they call that safe. It is not safe. It is just quietly and invisibly dangerous rather than visibly and dramatically dangerous. Now let me be precise about what I mean by productive assets. I'm not telling you to speculate. I'm not telling you to buy lottery tickets dressed up as investment vehicles. I'm telling you to own pieces of real businesses that produce things human beings need. Businesses with durable competitive advantages, businesses that have pricing power. Let me explain pricing power, because this is the single most important concept in inflationary investing, and it gets almost no attention. Pricing power is the ability of a business to raise its prices without losing customers. That is it. That is the whole thing. Simple to say, brutally hard to find. Think about it this way. If inflation goes to 8% and a business cannot raise its prices by 8%, what happens? Its costs go up by 8%, the raw materials, the wages, the energy bills, but its revenues stay flat. The margin gets destroyed. The business slowly suffocates. But if a business has genuine pricing power, if it sells something that customers cannot get elsewhere or cannot imagine living without, or are psychologically conditioned to associate with quality and status, then inflation is almost irrelevant. It simply adjusts prices and passes the cost to the consumer. I've always looked for these businesses. Businesses that sell something as close to a necessity as possible. Businesses where the customer has no real alternative. Businesses that have spent decades burrowing in the habits and routines of human beings so deeply that changing would feel like surgery. Think about the businesses you yourself cannot abandon. The insurance you have to buy. The utility that powers your home. The consumer brand so embedded in your family's routine that choosing a cheaper alternative feels genuinely uncomfortable. The software that runs your entire operation. These are not accidents. These are pricing power fortresses. Now here's the mathematical proof. Over the last 100 years, despite 2 world wars, the Great Depression, a dozen recessions, multiple inflationary spikes, and every form of financial catastrophe imaginable, the broad U.S. stock market has returned roughly 10% annually in nominal terms, which is roughly 7% in real, inflation-adjusted terms. Bonds over the same period, roughly 3 to 4% nominal, which in high inflation periods has been negative in real terms. Cash, you already know that answer. The businesses won. Not every year, not without volatility, without terror, without years where you opened your statement and felt physically ill. But over the long run, the productive assets that deploy human ingenuity and capital into creating value, those won because they were alive. And living things adapt. Cash does not adapt. Here's your assignment for Anchor 2. I want you to write down 5 to 10 businesses in your own life, products, services, platforms that you pay for and would genuinely struggle to stop paying for. Start there. Start with what you know. Start with what you already understand and already use. Then ask yourself, do I own any of these businesses? Do I have a stake in their future pricing power? Or am I just their customer, funding their shareholders' wealth? while my own cash erodes. That is your starting point. Not a stock screener, not a tip sheet, your own life, your own consumption patterns, your own lived experience of what has genuine staying power in the marketplace. Termeter, the real asset bridge. Now there is a category of assets that I want to discuss separately because it serves a specific and important function in an inflationary environment. I am talking about real assets, things you can touch, things that exist in the physical world and that human beings will always need regardless of what monetary policy does. Let me be clear about something before I continue. I am not a gold bug. I do not worship at the altar of precious metals. I do not believe that anyone who owns gold is inherently wise or that gold is some magical inflation hedge that the financial establishment is hiding from you. That is the narrative of salesmen, not investors. But I want to explain why certain real assets have historically preserved wealth during inflationary periods, and then give you my honest assessment of each. The classic real asset is land, specifically productive land, land that generates something. Farmland, commercial real estate, with real tenants doing real business. Timberland that grows trees you can eventually harvest, not vacant lots in speculative markets. Productive land. Here is why productive land matters in an inflationary environment. When the dollar loses value, what actually happens? The real goods and services a dollar was supposed to represent, they still exist. The food still gets grown. The buildings are still standing. The timber is still growing. The only thing that changed is the number of dollars it takes to claim those real things. And the owner of the real thing, they're fine. They simply receive more dollars for the same real output. Inflation, in a sense, flows through to the price of productive real assets naturally. This is why land, particularly farmland, has been among the most reliable long-term stores of value in human history, not because of any financial engineering, but because human beings always need food, and food requires land, and the supply of good farmland is, for all practical purposes, fixed. I have owned farmland for most of my adult life. Not because I wanted to run a farm. I know nothing about farming. I own it because the farmer pays me rent every year. And that rent adjusts upward over time as the value of the crops adjusts upward. It is about as close to a perfect inflation hedge as I have found in a tangible, touchable asset. Now let me address gold directly because I know you are thinking about it. Gold has one genuine use as an asset. It is a fear hedge. When people panic, when trust in institutions collapses, when currencies are questioned, when war or catastrophe feels imminent, gold tends to hold its value because it is the one asset that requires no counterparty. No institution needs to honor it. It just is. But here's my problem with gold. As a long-term wealth builder, gold does not produce anything. It does not wake up in the morning and figure out how to generate returns for its owner. It sits there. It has no earnings. It pays no dividends. It has no dividends. It has no pricing power because it sells nothing. Its price is entirely a function of what the next person believes someone else will pay for it. Over very long periods, 30, 40, 50 years, gold has kept rough pace with inflation, which means it has preserved purchasing power but not created wealth. It is a defensive tool, not a growth engine. Use it like a bulletproof vest. It protects you in the worst scenarios. But you cannot build a future wearing only a bulletproof vest. Here is the comparative scenario. Two men each have $100,000 in 2000. One puts it in gold. The other puts it in an index fund tracking the broad U.S. stock market. 23 years later, the gold man has roughly $800,000 in nominal terms. Not bad. He survived the dot-com crash, survived 2008, survived the COVID shock. He slept reasonably well. The stock market man with dividends reinvested has roughly $1.2 million. And more importantly, has participated in the actual growth of the productive economy, not just tracked the fear index of humanity. Both beat cash dramatically. But they are not the same thing. Here's your assignment for Anchor 3. Look at your current allocation. What percentage of your net worth is in productive assets, businesses, real estate generating income versus what percentage is sitting in paper claims with no productive engine behind them? I am not giving you a target number. Your situation is your own. But I want you to see the ratio clearly. Most people, when they actually do this exercise, are shocked by how much of their supposed wealth is parked in things that do not work for them at all. The fourth anchor, the velocity of the dollar here is one of the most underrated ideas in personal finance. In an inflationary environment, the timing of decisions matters more than almost anything else. I call this the velocity of the dollar, and it cuts in two completely opposite directions depending on the context. Let me explain both. First, the productive side of velocity. When I find a business I understand that has durable competitive advantages, that is available at a fair price, I move. I do not wait. I do not delay. I do not tell myself I will think about it and revisit it next quarter. Because in an inflationary environment, delay is itself a cost. Every month you sit on uninvested cash watching inflation erode its value. That is a real economic loss. It is as real as a trading loss. The only difference is it does not show up in red on your statement. It shows up as a quiet shrinking of what that cash can eventually buy. Delay feels safe. Delay feels responsible. Delay feels like patience. Sometimes it is patience, but in the wrong context, delay is just fear wearing the mask of prudence. Now, here is the other side of velocity. The dangerous side. In an inflationary environment, the temptation to act quickly to make speculative bets on assets whose prices are rising simply because inflation is rising is one of the most dangerous traps I know. Let me give you the extended metaphor. Imagine a river running fast, faster than normal. You can see things floating past logs, debris, various objects, and the temptation when you see a fast river is to jump in and grab something, move with the current, ride the momentum. But a fast river does not care about your intentions. It does not reward the bold and punish the timid. It treats everyone who enters it identically. And if you are not an exceptional swimmer, if you do not have deep knowledge and genuine conviction about what you are doing, the fast river will take you somewhere you did not intend to go. Inflationary periods produce fast rivers everywhere. Real estate prices rise, commodity prices spike, certain sectors of the stock market go vertical, and crowds of people who have never invested in their lives suddenly develop opinions about copper futures and oil stocks and farmland REITs. This is the dopamine trap at work. Rising prices feel like winning even when you do not understand what you own. The gain on paper triggers the same neurological reward as genuine, skilled performance. And that dopamine hit, that feeling of being right, of being smart, of having figured out what other people missed it, is one of the most dangerous feelings an investor can experience. Because it causes premature confidence. And premature confidence causes concentration without understanding, leverage without margin of safety, and eventually catastrophic loss. I have seen this play out in every major inflationary cycle I have lived through. The commodity bulls of the 1970s who extended themselves on the assumption that oil would hit $100 a barrel and never come back down. The real estate speculators of the mid-2000s who believed that prices in Phoenix and Miami simply could not fall. They were not fools. Most of them were intelligent people reacting rationally to the information they had. The problem was they were confusing momentum for value. They were confusing the fact that prices were going up with a belief that prices deserve to go up. Here's the mathematical proof on this one. If you lose 50% of your capital making a speculative bet in an inflationary asset that reverses a not uncommon outcome in commodity speculation, you need a 100% return just to get back to where you started. You are not back to zero on the work required. You are behind by more than half your time and capital, and you have lost something you can never get back. Years that compound interest could have been working for you instead of against you. The rule I live by is this. In an inflationary environment, the urgency to deploy capital into productive assets is real and appropriate. The urgency to speculate in hot sectors because they are hot, that urgency is a psychological product of watching your neighbors make money, not a signal from reality. Know the difference. The difference between investing and speculating is the difference between swimming across a river because you know where you are going and jumping in because the water looks exciting. Here's your assignment for Anchor 4. I want you to audit the last 3 financial decisions you made, not intellectually, actually write them down. And for each one, ask yourself a single question. Did I make this decision because I understood what I was buying and why it was worth buying? Or did I make this decision because prices were going up and I did not want to miss the movement? Be brutally honest. Most people, when they do this exercise, find that at least one of their last 3 decisions was the second type. That is not a catastrophe, but it is information. It is data about your own decision-making machinery, and you cannot fix a machine you cannot see. The fifth anchor, the margin of safety in your own life. Now, I'm going to tell you something about inflation that most financial commentators completely ignore. They talk about your portfolio. They talk about your investment allocations. They talk about your asset classes and your sector exposures and your duration risk, and all of that matters. But none of it matters as much as your personal financial structure, the architecture of your own economic life. Let me be specific. Inflation does not affect all people equally. This is one of the most important and least discussed truths about rising prices. Two people can experience the exact same rate of inflation and have completely different outcomes based on one factor: their fixed costs versus their variable income. Here's what I mean. If you have a fixed rate mortgage, you borrowed money at a fixed rate of interest before inflation rose, then inflation is actually your friend on that debt. Why? Because you are paying back tomorrow's depreciated dollars against a debt that was priced in today's more valuable dollars. Your debt is being inflated away. Your landlord, if you have a fixed rate mortgage equivalent, is the one getting hurt. Not you. But if your income is fixed, a salary that does not adjust for inflation, a pension with no cost of living adjustments, a fixed annuity, and your costs are rising with inflation, then every percentage point of inflation is a real wage cut, year after year. This is why I have always been deeply focused on the income side of the inflation equation, not just the asset side. Let me give you the extended metaphor here. Think of your financial life as a bridge. Not an ornamental bridge, a working bridge that has to carry real weight every single day, and a bridge is only as strong as its weakest structural element. Most people, when they think about inflation protection, think about adding stronger steel beams to the top of the bridge, better assets, higher returns, more sophisticated investments. But they completely ignore the foundations, the piles driven into the earth. And if the foundations are rotten, if your cost structure is fragile, your income is fixed, your lifestyle requires a dollar amount that grows faster than your income, then it does not matter what you built on top. When a storm hits, the bridge collapses from the bottom. What does a strong financial foundation look like in an inflationary environment? First, your income must have pricing power too, not just your portfolio. If you are an employee, you must be in a position to negotiate real wage increases that match or exceed inflation. If you cannot do that in your current position, that is critical information. It means your employer is extracting real economic gains from you every year that prices rise while your salary stays flat. I'm not saying quit your job. I'm saying understand the economics of your employment. See it clearly, because many people are so focused on the stock market that they miss the fact that their single largest asset, their own human capital, their income-generating capacity, is being silently devalued. Second, your fixed costs must be genuinely fixed or ideally declining as a percentage of your income. If you have variable rate debt credit cards, adjustable rate mortgages, variable rate business loans, and inflation forces interest rates higher, your costs go up automatically. Every percentage point the Fed raises rates is a direct extraction from your monthly cash flow. This is not hypothetical. This is what happened to millions of homeowners when rates rose from near zero to over 5% in just over a year. Monthly payments on adjustable mortgages went up by hundreds of dollars with no warning. People who had stretched to buy more house than they needed suddenly found themselves squeezed from two directions: rising costs of living and rising debt service costs. The margin of safety in your own life means living below your means, not as a sacrifice, but as a structural decision. Not because it feels noble to be frugal, but because margin is what gives you the ability to act when everyone else is paralyzed. Here is the mathematical proof. The person who saves 20% of their income and lives on 80%, when a financial shock arrives, they have room to maneuver. They can temporarily reduce their savings rate. They can absorb a month of higher costs. They have cushion. The person who lives at 100% of their income or at 110% with credit has zero margin. Any upward pressure on costs is immediately a crisis. And crises cause panic, and panic causes the worst financial decisions of a lifetime. The research on this is unambiguous. The families most financially destroyed by inflationary periods are almost never the poorest families. They have nothing to lose, and they are almost never the wealthiest. They have assets that adjust. They are the families in the middle who are living exactly at the edge of their means with no buffer, no margin, no capacity to absorb a shock. Do not be that family. Here's your assignment for Anchor 5. Sit down and calculate your personal inflation sensitivity. Look at your monthly expenses. Identify which ones are fixed rent or mortgage, loan payments, subscriptions, insurance, and which ones are variable and likely to rise with inflation: food, energy, transportation, healthcare. Then look at your income. How much of it is truly inflation protected, either because you have pricing power in your career or because you own assets that generate returns that adjust with inflation? The gap between those two numbers, that is your inflation vulnerability, and seeing it clearly, even if it is uncomfortable, is the beginning of actually doing something about it. Back. Now let me set the framework down for a moment. Let me stop being the teacher and speak to you as something else for a few minutes. I am 93 years old, and I have sat at bedsides. I have been in hospitals at the end. I have watched men who had done everything right on paper. Everything this video talks about, everything I have spent my life preaching, reach the end of their lives and discover that they had built an extraordinary fortress with nobody inside it. There is a test I have given myself throughout my life. I do not call it the rocking chair test, that is too passive for my taste. I call it the dinner table test. At the end of your life, when the people who matter most to you are sitting around a table, not at your funeral, before the funeral, while you are still there, what is the conversation? Is it a real conversation? Are there real relationships at that table? Do the people sitting there actually know you? Not your net worth, not your track record, not your portfolio allocation. Do they know you? I have known men worth hundreds of millions of dollars who had no one at that table, who had optimized so aggressively for financial performance that every human relationship in their life had been squeezed out by the relentless focus on the scoreboard. And let me tell you, the scoreboard does not keep you company at the end. I say this not to moralize, not to lecture you about balance. I say it because I have made my own version of these mistakes. I have been so consumed by the game at certain periods of my life that I looked up and found the people nearest to me had grown distant, and the work of rebuilding that it is harder than any investment I have ever analyzed. Here is the truth I want to leave with you on this point. Money is a tool for freedom. That is all it is. The hammer is a magnificent instrument if you are building something worth building, but a man who spent his entire life perfecting his hammer technique, collecting the finest hammers, admiring other people's hammers, that man has confused the instrument for the purpose. The purpose is the life you want to build. The freedom to be present with the people you love. The security to make choices from a position of strength rather than desperation. The capacity to be generous, genuinely, voluntarily generous without calculating what you are losing. Inflation threatens all of that if you let it quietly dissolve the material foundation beneath your freedom. And that is why the anchors we talked about today matter. Not because wealth is the goal, but because financial fragility is the enemy of the life you actually want to live. Do not confuse the two. Plot me bring this home. We covered 5 anchors today. The purchasing power lens. Stop measuring wealth in numbers. Start measuring it in what those numbers can actually claim in the real world. The productive asset fortress. Own businesses with pricing power. Own living, breathing, adapting economic organisms instead of paper that quietly dies. The real asset bridge. Understand what tangible assets actually do, what they protect against, and what their limitations are. The velocity of the dollar. Deploy capital with urgency into things you understand deeply, and ruthlessly resist the temptation to speculate in things that are merely rising. And the margin of safety in your own life before you worry about your portfolio. Fix your foundation, your income, your fixed costs, your personal financial architecture. These are not complicated. They do not require a finance degree or a Bloomberg terminal or a team of analysts. They require clarity, honesty, and the discipline to act on what you understand. And that is the hardest part. Not the understanding, the acting. I have given lectures at universities where every student in the room nodded along intelligently, wrote careful notes, asked thoughtful questions, and then went home and changed absolutely nothing. Do not be that person. Information without action is useless. Wisdom without execution is vanity. You know what inflation does to cash. You know what pricing power means. You know what your margin of safety looks like. You know what the dinner table test reveals about whether your financial life is serving your actual life or consuming it. Now go do something with that knowledge. Not tomorrow, not after the next market correction or the next Fed announcement or the next piece of information that makes you feel more certain. Today. Now. One step. The door is open. It has always been open. That's all. Thanks for watching.